Well, it felt a little bit like the calm before the storm last week. Equities continuing to move higher, the dollar rebounding just a little bit, but overall markets relatively contained with volatility relatively low as traders just twiddled their thumbs ahead of what is a monster week of event risk this week. We've got decisions from the Fed, the ECB and the Bank of Japan. We've got about 50% of the S&P 500 by market cap reporting earnings, including some of the big tech names such as Google, Microsoft and Meta. And we've got a busy slate of economic data as well. GDP out of the States, a whole host of PMI and sentiment surveys, and much else besides that too. So there's plenty for Ryan Littlestone and I to get our teeth into on the trade-off this week. Without further ado, let's get into the show. So as I said in the introduction, a veritable bonanza of event risks for traders to have on the radar this week. Let's bring in my co-host to break it all down for you, Ryan Littlestone from Forex Flow Live and Forex Analytics, accompanied by what I think is the world's loudest computer in that room with you there.
Yes, getting a little bit hot here in the office, so the fans are on overtime at the moment. But yeah, well, I'm sure we'll get through the show probably.
I'm sure we will, mate. It's very British of us to complain about the weather, but I don't think we can in terms of the heat, given that Kyriakos is currently sat there in 42 degrees Cyprus. I think we should be quite thankful for the rather grey and grim skies that we got out there today in many ways.
Yeah, definitely, though. Could do a bit of sunshine. It's supposed to be summer, first day of the school holidays, and typically the weather's bad. So, yeah, welcome to English weather.
Well, exactly. And of course, the weather entirely ruined the cricket over the weekend, and that's been rather fun in the office working for an Aussie company this morning. But anyway, let's get on to more interesting matters and look forwards to the huge week of central bank decisions that we've got coming up. So, three really important, key, interesting central bank meetings on the deck this week. Kicking things off is obviously the Fed on Wednesday evening. I think a 25 basis point hike from the FOMC is all but certain at this point. If you look not only at the dot plots, if you look at all the rhetoric we've heard from voting and non-voting members of the committee, and the market, of course, pricing that as around a 95% chance. And I think I pulled the data on this a while ago to school someone on LinkedIn. You've got to go back to 2007, 2008 for the last time the Fed deviated from the consensus going into one of their policy decisions. So it will be an absolutely huge surprise if the Fed didn't deliver a further rate increase this week. They've got plenty of ammunition to do so in terms of the economic data. Inflation is still well above target, particularly when you look at some of the core gauges. The labour market is incredibly resilient. Unemployment is very, very low indeed, close to cycle lows, and prime age participation is almost at a record high, so it's highest since 2002. And of course, the growth side of the equation doing well as well. GDP growing by 2% in the first quarter, should print a similar pace of growth in Q2. We do get the latest PMIs while we're filming this, and hopefully they don't cast too much doubt on what I've just said. But I think given that markets price in such a hike with such a degree of certainty, and this is going to be a bit of a running theme for all the central bank decisions we get this week, the focus really is on what happens next, what happens in September. And I think I'm keen to get your views on this, Ryan, but personally, I don't really see too much in the way of shifts coming from the Fed this week. That data-dependent tightening bias should stay in place. They'll allude once more to additional policy firming. We've got an awful lot of data coming between the two meetings, another two jobs reports, another two inflation numbers. But I do think, if anything, the risks are probably skewed to more of a hawkish surprise, just given that the market is only pricing in, 10 basis points more tightening after a hike this week.
Yeah, I think there's two key things that we're going to find out from these meetings, or hope to find out. The first, obviously, we know we're getting a hike. The second is, do we get a secondary hike? But in the bigger picture, the market knows we're pretty much at the end of the hike cycle. At least we're going to get a pause, whether it's one more hike, two more hikes, or whatever. This is the same theme for both the Fed and the ECB. But really, I think the message that the Fed are going to want to give is that they're keeping rates up. They're not potentially going to declare that they've seen the end of inflation and, do victory laps and pats on the back. and they're ready to move on. I think they need to keep the rhetoric strong, and I think that's going to be what the hawkish message is. So you're quite right. It's what they're going to do next, but it's also how they keep the market on the hawkish side, because we're already starting to price cuts into 2024, and Powell won't want to let those expectations, that snowball really start gathering speed, because then it undoes a lot of what they've done with hiking so far. So I think, a hawkish Fed without being hawkish on rates, and that's the dilemma they've got, to keep that message in without the market going, okay, boom, done, we're done with rates, next thing's cuts, and the dollar gets smashed.
Yeah, I think that's exactly it. It comes back to that point we were making, really early in the year, kind of January, February time, around, not just raising rates, but ensuring that financial conditions stay tight. Because if they start to loosen off quite considerably, then all of a sudden you're going to start seeing the market effectively undoing a lot of the work that the Fed has done to try and bring inflation under control. And I think, again, as a result of that, we're going to get a pretty stern warning to markets that rate cuts are by no means likely this year or potentially next year as well, at least in the early part of next year. And I think that's perhaps why a second hike, if it is to come, might be more likely in November rather than in September, because it just pushes out that timeline for markets to price easing. You get to the September meeting, you have another hawkish statement, you leave the dot plot unchanged, maybe move the 2024 dots up a little bit, and it just keeps things tighter for longer. And you remember, probably a year ago, the Fed was saying rates are going to go higher than you expect for longer than markets expect. Well, we've kind of done the higher bit now. Now we're into the long bit, and how long do we stay at these levels? And again, I think it is still a case of we're going to stay here longer than markets expect. Markets price 50 bips worth of cuts from current levels in the first half of 2024. I don't see that happening at the moment.
Yeah, exactly. But we nailed it on the show months ago, when we had the FOMC, and the risk from that particular FOMC was not whether they were going to hike again. It was the 2024 dots, and whether they were going to kick those much higher to reinforce that message. And they did just that. So I'm expecting similar rhetoric from Powell this week to keep that message in. But they, it's a trade-off, acknowledging that maybe at the peaking rates, and just like us, and keeping the message there. So it's a fine line that all central banks are going to be walking at the moment.
Yeah, absolutely. It's all about the rhetoric, all about the guidance from the Fed. We'll pay laser-like attention to Jay Powell's press conference. Please tell me we don't need to do the same with Christine Lagarde.
Of course we do. We're all going to be sitting there with our pots of coffee and our colour charts to gauge her tan as to how hawkish or dovish she may be. If we take all the talking heads at their word, this week's hike is nailed on, a bit like the Fed. They're going to go 25. But what we've seen is whether they're going to go for a September hike. And the expectations have drifted lower for this, mainly because of the expectations for the Fed drifting lower too. They've been called in the same sort of wind, same for the Bank of England too. So the market is a lot less certain about a SEP hike than they are for the Fed. We're expecting a 60% chance at the moment of a ECB hike in September. That's about 16% for the Fed. So you can see there's a big difference there. But as mentioned, we're pricing cuts for the Fed. We're not quite pricing cuts for the ECB yet into 2024, although the rate probabilities are much lower there. And I think that's fair. Pricing 60% for the ECB, I think, is potentially fair. But as we're saying, what's more important for the market is that we're coming to the end of the hike cycle and what happens after that. Now, one of the key signals for this last week was one of the biggest ECB hawks, ECB's not, coming out and saying that he thinks core inflation has plateaued and that more hikes after July would shift the balance of risks towards doing too much, thus making future hikes past July uncertain. The data out the Eurozone isn't encouraging either. We just had the latest PMIs, manufacturing and services. Manufacturing has taken another nosedive. Germany, 38.8 on manufacturing. They're in all sorts of problems. Services, they still remain in positive territory, except in France. So there's still a chink of light there for the bigger sector. But as we know, it's inflation that's the key. for the ECB. Headline CPI has been coming down, still tracking lower, but that core is still stubborn, and it actually went up last month by 2 pips. So that's the important thing that Lagarde will be concentrating on, and hence why she may be pushing for that September hike. But one big issue that apparently is rearing its head for the Governing Council is how they communicate a potential end of hikes. So that's going to be something that we're going to have to pay attention to. Lagarde's often talks during the press conference about large majorities. I'm in favour of this, that and the other. Then after the press conference, we always get those sources pieces a few hours. That gives us maybe something a bit more truer as to what the thinking is behind the scenes. But then another risk point is, if they indicate a pause for hikes, are they going to ramp up QT? That will be a potential hawkish signal if they are going to, put a bit of a pause on hikes. So key things to watch, particularly from the press conference. And yes, we have to listen through Lagarde.
Oh, good. You know what? There's nothing I would rather do on a Thursday afternoon. I mean, you think about it, this Thursday, 1:45, there's 2 things happening. One is Christine Lagarde stands at a podium in Frankfurt with a stupid outfit and scarf on and starts waffling about monetary policy. And the second is it's right at the start of the afternoon session of the 5th Test match at the Oval. I really know which one I'd rather watch, but I also know which one I have to watch. And sadly, they're not the same thing. I think Europe is in a bit of a mess at the moment. And I must say I'm surprised that the FT haven't blamed that slump in the PMIs on Brexit just yet. That seems to be what they usually end up doing. But if you look at it, I mean, as you said, you've got core inflation, which is just stuck at 5.5%. It doesn't seem to be showing any sign of, yes, deviation either side of that, but the disinflation that we see in the headline number certainly not feeding through into core inflation, which just shows how much of that it's due to energy and to food prices. As you say, the PMIs that we got this morning were just plain ugly, let's be honest. The services numbers at their lowest level since the start of this year, the manufacturing numbers at their lowest level since the latter days of the pandemic in 2020. Of course, you've also got what's going on in China. The Chinese economy is slowing pretty significantly, and given the huge trading relationship between Europe and China, that's obviously going to have a detrimental impact as well. And I think it just comes back to that age-old trade-off that the ECB are going to have the summer to really mull over, and of course more data to help them with that, whereby what's more important? Is it controlling inflation at all costs, or is it propping up some degree of economic growth? Of course, the hawks would veer towards the former of those arguments, although Klaus Knott, as you alluded to, has started to cool a little bit on that rhetoric. The doves would veer towards the latter side of that argument. And I don't think we're going to get any clues as to which side wins that at this meeting, but certainly after the summer break in the first couple of weeks of September, I think it's just going to be a barrage of speakers one way or another. And if we do see that momentum continue to slow, and if we see services go the same way as manufacturing in terms of output, then I think that really casts doubt on the chances of another hike. Yeah, definitely. And we've got to look at the data. We're still seeing PPI coming in very weak. Spain today, I think it was down 8.1%. And, we're getting some big year-on-year negative numbers now coming out of the PPI. And that's going to filter through over the months ahead. There's a bit of a lag between PPI and headline CPI, which shows us the stickiness we may have to go through before we start seeing decent numbers in the CPI. Yeah, absolutely. And I mean, you could be looking conceivably at a situation in 2 or 3 weeks where you've got a really big mispricing in terms of rates, because as you said, the ECB markets see about a 60% chance that they hike again in September. The market sees about a 20% chance that the Fed hike again in either September or the following meeting in November. And if you get some solid US data as we continue to see. We've got the jobs number on the 4th of August, the first Friday of next month, of course. And if we see a relatively hawkish stance from Chair Powell, you couple that with a continued softening of the figures in Europe, and perhaps even a little bit of disinflation coming into that core number, then all of a sudden it's looking a lot more likely that the Fed hike again and that the ECB don't. And then you've got to ask, where does that put euro dollar? I would imagine not particularly close to 111, which is where it trades at the moment. Yeah, and that's going to be the fun this week. I think we're in for a lot of moves. We're in for a lot of volatility just in between the data points and events. So
going to be hard to pin down the price over the next week or so, but that's what we try to do here.
Yeah, absolutely. Well, let's get on to the last one of these central banks, the Bank of Japan. I'll ask the question I often ask when we discuss the BOJ. Are you getting up early for the BOJ on Friday, Ryan?
I might have to for this one. It's going to be an interesting meeting. There's been a real roller coaster in the expectations for this one over the last couple of weeks. We started off with no expectations. Then Japanese sources pieces suggested that the BOJ would be hiking their fiscal year 2023 inflation forecast above their 2% target. And then the Japanese government hiked theirs last week. They took them from 1.7% to 2.6%. That's a huge move.
It's just a rounding error, isn't it?
Yeah, and again, above the Bank of Japan's target. So, these guys don't tend to move in such large clips. So it shows the feeling that's going on over there. And so the market started getting expectant about tweaks of YCC from the Bank of Japan. Just to be clear, no one is expecting any sort of interest rate move at this meeting. It's going to be about the forecast and YCC. But then we had a period of silence from the Bank of Japan, who would have been watching all these expectations grow in the market, suddenly buying yen in anticipation of action. I noted it last week that it's very rare not to hear a peep out of those guys. But then Eurida finally popped his head above the parapet just to take some air out the tyres for those expectations. And he said there's still some distance to sustainably achieve the 2% inflation target, which the market then took as closing the door on any action this week. Then on Friday, we got another sources piece from Reuters this time, and they had some key lines in there saying that the BOJ is said to see little need to act on yield curve control for now, still not confident about hitting their price goal stably, and said to view keeping easing as important amid any progress. But there were two lines from both those stories that are picked out and just niggling in the back of my mind, three lines actually. Firstly, Ueda, among those comments, he said that the BOJ narrative of monetary policy won't change unless our assumption on the need to sustainably achieve 2% target changes. So it's on their assumptions on whether inflation meets their target. Now they're highly expected to raise their forecast above target this meeting. So does that fulfill the need or answer the question about changing their assumptions? I think it does. I think that leaves the door open. But in that Reuters piece, again, two key points in there. BOJ is said to reach a final decision after viewing the latest data. The latest data, if you're talking inflation, was that inflation rose in both measures, up in CPI, up in the core. Now a year of rising inflation, or over a year rising inflation, still well above target. And that they're still going to discuss a YCC change, even if there's no tweak. To put it all in a tradable form, if you like, or trying to give an idea of what may happen, I've got three possible scenarios. The first one, very bearish, no action, no tweaks, no forecast changes, no language changes, no hints, no nothing. I think it's a very low probability, but if they do stay unchanged throughout the whole thing, I think something like dollar yen is going to be quickly back through 145, probably on its way to 150. My base case is the middle of the road, option B, if you like. There's no action, but they do raise these forecasts above target. Keep an eye on the fiscal year 2024 as well, where they keep those below, at or above target too. I think they put in a language change reflecting the change in those inflation assumptions to more hawkish, maybe hints about a tweak further down the line. I think that sees some good yen strength. Dollar yen probably back down towards 138, depending on where we are. It's definitely going to be yen strength. And then thirdly, the most bullish case, they hike their forecasts, they tweak YCC, the language is hawkish, even though it might still be cautious, and we're probably going to see a massive bout of yen strength on that. That'll give them some breathing space, particularly because then the market moves and it's ready for the next step, so there's not going to be a huge months of repricing and guessing thereafter. But as usual, we may see the market overreacting to that, and then potentially that gives us a trading opportunity. But that's my three baseline or three possible scenarios for the Bank of Japan. So let me ask you now, what are your thoughts on Mr. Ueda on Friday?
I'm not sure I can add anything to that, mate. You've summed that up so brilliantly and comprehensively. I struggle to pick holes or to add any further value to it, in all honesty. I do think, though, it just comes back to what we were saying a while ago in terms of any shifts from the BOJ. They're going to be so gradual and so slow. And that's exactly what we're seeing. We're now talking about, a tweak to the inflation forecast probably this year and next year, which will then lead into maybe a yield curve control tweak at the following meeting. It is a very slow, gradual process. They've had 2 decades of ultra loose policy. It's not a case of let's just hike rates now when no one expects it. But I do think it is quite interesting that you could end up with a situation where the BOJ and the Ministry of Finance are almost fighting against each other in terms of the value of the yen. I mean, it's been quite clear for some time now that the Ministry of Finance in Japan don't really want dollar yen to weaken too rapidly north of kind of 145 or 150. Of course, the speed of the move being more important than the level, as we've seen previously. But it could also be a case where the BOJ are saying, we're not quite ready to move just yet. And if so, then you've got monetary and fiscal levers working in opposite directions. But it'll be interesting to see how it pans out. The only thing I would add is the Bank of Japan, for whatever reasons, still in this day and age, don't have a set time for their announcements. And the general rule of thumb is, and this is just a rule of thumb, there are some exceptions to it, but the rule of thumb generally is the longer time goes on, the later they tend to make their announcement, the more likely it is a policy change may take place. And everyone in the market seems to go by that rule. So bear in mind, if time does tick on and you are awake trading that, don't be too surprised if you start to see the yen rally a little bit in anticipation of a change before, or maybe even a change isn't announced, but before the actual announcement drops, just as people start to think, this is taking longer than we thought, it must mean they're going to do something. Often it does, but often the BOJ have had the potential to surprise us as well.
Yeah, definitely. And I think we might have had some of that dry Japanese humour as well, because on Friday, when we got all those sources pieces that sent the yen up 180 pips in the morning, we got the Japanese currency diplomat Kanda out saying they're watching against excessive moves. And it's like, well, you've just caused the moves and now you're having a moan about it. So, some humour in Japan.
Exactly that. Stop leaking stuff to the papers and then you won't move the market. It's quite simple. Anyway, economic data, we've got an absolute ton of it on the slate this week. As you alluded to earlier, we obviously had the PMIs out of the Eurozone earlier, which were absolutely grim. You've got a note on your slide here which says add data bracket, close bracket. Well, there's no need to add the data because, one, we've already gone through it, and two, it was absolutely horrific. And actually the UK PMIs weren't much better either, as Kit Dukes, the chief FX strategist at SocGen, said the UK data looking decidedly European, and probably not in a good way either. But we've got plenty out during the rest of the week as well, haven't we, mate?
Yeah, we may be in that final furlong for central banks, but the market is still going to move around on the data and jockey around on the week's data ahead of the central banks. We've seen that this morning in euro dollar as all those PMIs came out cable as well. On Tuesday, we get another big number. We get the US consumer confidence number. This is the main one, the conference board one. Now, will it match the Stiller reading it had last month and that we saw in the Michigan data a week or so ago? We're expecting 111.8, some in expectations up for as high as 113 versus the 109.7 prior. So that's going to be important for any last minute Fed trading. All eyes need to be on those inflation readings as well, the 1 year inflation number and the longer term, because that also plays into the markets trading for the Fed. Post the Fed and ECB, we get US Q2 GDP numbers. It's going to be the first of the majors to drop their quarterly data. Expecting 1.5% quarter-on-quarter annualized versus the Q1 final of 2%, indicating that there's no recession imminent. Same can't be said of France, who also bring out their numbers too on Friday, and I think Friday or Thursday, and they're expecting 0.1 on the quarter versus 0.2 in Q1. So small margins there between what might be a positive and negative reading. And as much as this week will tell us a lot about the central bank stances, this data will confirm their thoughts or set the market on a different path to how it sat right after. So if the Fed's very bullish, the economy very hawkish, and we get a really poor print in GDP, the market's potentially going to flip how it traded the FOMC. So it's going to be important that we watch this data leading up to and after the central banks that we've got coming.
Yeah, absolutely. It is, excuse me, an incredibly busy week. And I think some of it may end up getting a little bit overshadowed by those central bank decisions that we've got coming up. But of course, in the bigger picture, all of it continues to add some colour to what's going on and helps us frame the bigger picture ideas. And of course, the policy outlook as well. Beyond this week, we said earlier that what the Fed do is going to depend largely on how resilient the economy remains. What the ECB do depends on, how well growth continues to hold up and which side of that divide they come down on. And all the figures that we get this week are really going to help provide additional clarity on that front. The other thing that I would mention, just in terms of this week being incredibly busy, is not necessarily economic data, but corporate earnings. We've got an absolutely ridiculously busy slate of corporate results this week. We've got Microsoft and Google after the bell Tuesday. We've got Facebook or Meta, whatever they're called nowadays, after the bell on Wednesday. I think we've got Intel reporting after the close on Thursday. All in all, it's about 160, 170 companies this week, 50% of the S&P 500 by market cap. So particularly if you're trading indices, or if you're trading other risk proxies, things like the Aussie dollar, the Kiwi dollar, things like that, gold even, it's not just the Fed, it's not just monetary policy, it's not just data, it's also earnings. There's going to be a lot of moving parts this week, and I think that speaks to a broader point where this is not really a week where you want to be kind of chancing your arm. It's more about preservation of capital, and there's absolutely no shame at all in sitting most of this out and coming back next week or even in September when the dust has settled and things are a little bit clearer.
Yeah, so are you going to be giving us a rundown on all those reportings next week, mate?
Oh, we've got about 3 hours for this show, and then we might be able to squeeze it in. If there's any important ones, I will. Let's put it that way.
I'm just palming it all off onto you. That's all I'm doing. That's all I'm interested in. As long as I don't have to.
As always. Right, let's move on to some charts then in that case. That title sequence seems to get longer every week, and I'm sure someone's just doing that to wind us up at this point. Anyway, I want to start things off this week with the FTSE 100. I haven't mentioned the UK benchmark for some time, but it was get your flags out, get the bunting out, celebrate, start singing Rule Britannia. It was the best performing developed market equity index last week, gaining just over 3% over the last 5 days or so. Of course, the decline that we saw in cable having a huge impact here, as everyone should know by now, the FTSE has a very close inverse relationship with sterling due to the huge number of firms in it with a decent chunk of their earnings coming from overseas. They are obviously worth more when they are repatriated back into the UK for accounting purposes if sterling is weaker. But you did also have, and I mentioned this at the start of the show, I think, a bit of a tilt towards value and a bit of a tilt towards defensives last week. And the FTSE is absolutely chock full of those sort of names. And that was also helping the market to gain ground. And importantly, we broke above all three of the key short and medium term moving averages last week, the 200-day, the 50-day, and then we closed above the 100-day moving average on Friday. And we held that level on a retest this morning, on Monday morning, for those of you watching this later in the week. I think the bulls are trying to get some control of proceedings here. 77 and 7,800 are the obvious levels to watch to the upside. As most will know, I am bearish sterling. I'm still bearish sterling. And I am quite bullish on the FTSE at this point. So I think as long as and global equities more broadly, and as long as we're above the 200-day moving average, then I'd be comfortable favouring upside here and buying on any dips if they occur.
Yeah, the FTSE is a strange one with its correlation to the currency. We've seen a lot of other indices, back to those all-time highs and yearly highs, so on and so forth. And the FTSE feels like it's just hanging back a bit. And, could you see a scenario where the data may turn bad, but the currency is going to drive this higher, where other equity markets are going to fall on poorer performance?
Yeah, absolutely. I mean, one of the best analogies to that is after the EU referendum. Sterling was off a cliff. I mean, we were there. It was down, 15-20% over a couple of weeks. Cable went from 155 to the high low 130s, but the FTSE actually remained relatively resilient. So the power of a currency in driving equity market performance is huge. We've seen that already this year with the Nikkei over in Japan. A huge chunk of the gains there have come from the dramatic weakening that we've seen in the yen. So I see no reason why the FTSE can't do the same, and certainly for the sake of my pension, hope it does.
Yeah, you and me both, mate.
Yeah.
Otherwise, we were doing this in t-shirts and next week.
Exactly that. Well, what about oh my word, I've seen you've written War and Peace on the yen again.
Oh, dearie me. Do you want analysis or what? This is what we're here to do. Always having a moan about something, you are. Oh dear. I won't mention what you were moaning at before the show when I first joined the call, but we'll leave that up on Twitter later. But dollar yen for me, because this is one of the main pairs I'm going to be looking at this week, obviously, for everything that's going on. It's been it's been a game of two halves, well, more like a game of three halves. We had the big run up from 127, all the way up to 145 on the back of the Fed rate expectations. That topped out at 145. The second half was all the tweak expectations of the BOJ, running it all the way down to the 137.20s. The third was EURUSD and the sources pieces, washing out all the tweakers. So there's been lots of vol, but technically the pair has traded like a dream. It's respected the big levels where it's needed to. Last week I said that the 137.20 move looked a bit of an overextension on the break of 138. We needed to get back up through 139. We had a couple of goes to do it. The first one was on the Michigan data that came in strongly. That failed. Then we had US retails, which initially sent dollar yen lower because the way the data comes out in bits and pieces. We saw a lower read for the headline number, 0.2%, missing expectations. Then the core came out stronger, 0.6, and we reversed and had another go. That failed at 139 as well. Then UEDA came out with his comments, and we were off to the races. So we had a big run again on Friday on the back of that Reuters sources piece, but I think that leaves us fairly balanced now going into the Fed and the BOJ. Both sides of this trade have made a bit of money and have been forced to cover quickly. 141.90, 142 is our nearest main resistance point. We've just had a little nibble under 141 as we're speaking here now. We're back above 141 now. That's going to be the main support here. But one trade idea I'm looking at is to maybe get short a rally on the back of a hawkish Fed to run into the Bank of Japan. As I said earlier, I can't see the BOJ, coming out of this meeting on the dovish side at all. So I'm going to try and maybe have a plan to take advantage of any Fed-induced JPY weakness to yen weakness to maybe position for some strength. I'm already long this trade from last week, so I've got some margin, but I think maybe a hawkish Fed, chop that long into a short, run it into the Bank of Japan.
Yeah, it's going to be an interesting one. And actually, I think this week is going to be a game of two halves as well. It's a Treasury story up until about the close on Thursday. And then all of a sudden, this is all about what the BOJ do and say and do in the early hours of Friday morning. I think I said last week we might range between kind of 137, 138 and 141. Obviously, as your chart shows, we've broken just slightly to the upside of that. But yeah, I think for me, it's kind of the 142-ish region to the upside and that 138 to the downside. They've marked themselves out as very, very key levels for now. So for those looking at longer term positions, as the dust settles on what we hope is a busy and volatile week, it is which side, or are we in the range? And if we're not, which side of the range are we on? And then trade that as appropriate, I think.
Yeah, and it's difficult with weeks like this to try and pick price levels because You can't say I'm going to trade the Bank of Japan at 142 when we get the Fed, and that might send us to 138 or might send us to 145. So really, these are types of weeks you have to react to the price. Get over one event, see where the price is, plot your levels, then you can take that into the next event. But there's no point trading the Bank of Japan now when you've got the Fed right in the middle.
No, and actually another point I'd make on that just very quickly is it's very important with these central bank decisions, not just this week, but any time we come up to a sort of bonanza like this, trade what they do, trade what they say. Don't trade what you think they should do or what you think they should say. They are two very, very different things. If you're someone sat here in the UK trading sterling, you're short sterling, and you've got a mortgage coming up for renewal at the end of August, you're probably wanting the BOE to hold or to cut rates. They're not going to do that. Don't trade your view, trade their view, because that is what moves the market. Rant over.
Very sensible. Look at that. You're learning.
Just a little bit patronising.
No, right. very sensible advice, as always.
Thank you, mate. Right, gold. Gold's an interesting one because I don't like gold. Let me get that out there first of all. I've often put gold in what I would call the too hard box, where it more often than not seems to move in an entirely random and illogical direction, totally detached from most of its fundamental drivers. And also the fundamental drivers of the yellow metal seem to change on a whim. One day it's risk appetite, the next it's the dollar, the next it's yields, the next it's neither of them or none of them. And that seems to be kind of what's happening again. We're continuing to print higher highs and higher lows, and we're in this upward trending channel that I've put in that nice turquoise color on the chart there. But if you think about what happened last week, we saw nominal yields move higher, quite substantially higher at the front end of the curve. The 2-year was up around 10 basis points on the week. Real yields moved higher as well, and the dollar, of course, rebounded with the dollar index back north of 100 and 100.85. I think we were up just over 1% on the week. So I would argue that you've almost got a bit of divergence here between the technical picture, which is pretty solid. We're above we're within this upward channel. We're above the 50 and the 100-day moving averages, and the fundamental picture, which would say actually this rally is on shaky ground just a little bit. So I wanted to bring this chart out just because you've got that divergence going on. Personally, I'm in sort of wait and see mode here. I think the Fed are going to be by far and away the main driver of where this goes next. If we get below 1950, then I'd be looking for shorts. If we get up towards that 2000 mark, then you may be looking for a breakout to the upside of the channel and to get long. But I just think it's interesting how the technicals and the fundamentals do seem to be telling a little bit of a different story here, which is important. And, you know, this is coming from me of all people. I think it's why it's important to use a blend of both rather than just being married to solely technical analysis or solely fundamental analysis when looking for positions to put on.
Yeah, exactly that. And this one pretty much is one where at the moment you probably want to be a bit more reliant on the techs. I've got pretty much similar levels to what you have. We've obviously got the big 2000 up above here, which is always going to be a psychological level. But we had the 1930s area, which I think I showed in a piece a few shows ago. 1930 was a bit of resistance. We got back above that. We held it as support. We had a sort of intermediate number around 58, 60s, that sort of area. We broke that. We went up to the next level, 1985, 86. That's where we've topped out. We've come back down to that 60 area, as you can see on the chart. So it's a bit sort of in the middle of that channel that you've drawn there. And you're quite right. If you trade at either side. If you think that this 60s is going to hold, that's where you get long. You don't need to keep put a big stop on it. If you're through 55, 50, then you're going to be wrong and you're heading towards the lower bound around the 30s. And, if you don't know the reason why something's moving, stick to the techs and trade them accordingly.
Indeed. What about Aussie Kiwi? A little bit of a rogue one from you, Ryan, there, going down under.
Yeah, this is one. And it's one of those charts where I look at now and again and I don't really see anything massively interesting to talk about. But then I had a little zoom out just to check all the time frames like I do on a lot of charts, just to get the overall picture. And this one, we talk about patterns in FX, and they can be very important for trading. And the Kiwi, it has a historical pattern that's been very interesting pretty much since 2024. This one has gyrated around the 108 level often, and has kept itself to quite a tight range. So there's two secondary levels around 111 and 105. So either side of this 108, and then we've got a couple of extension levels outside of that range. So I think there's potentially good risk reward trying to play the edges of this 105, 111 range, and also potentially the extension moves, and then looking for that price to revert back to this 108 line at some point. That's the sort of level I'll be using as a place to take partial profits or all profits, and then see which way it wants to go next. Which way is it going to pivot on that 108? Now, I think trading this one may require a lot of patience, but it's not one you need to watch all day long, every day. Put it on a post-it note, set some price alerts, and then if those come off, you have a little look at the chart and see what it's doing. But yeah, it's interesting that it keeps coming back to this 108 level, and if you get a nice tight ranges in a pair, that's often very good to trade.
Yeah, absolutely. It is a very kind of sticky level, this 108 handle. I think it was one that I brought up ages ago, trying to fade a move all the way back down to kind of 104, 103, and just never came off. I do wonder whether we're going to see a little bit of policy divergence come in here as well. Of course, you've got inflation data out of Australia a little bit later on this week, I think in the early hours of Wednesday morning UK time, if I've got that right. Certainly I won't be awake for that. But of course, the Reserve Bank of Australia looking like they're going to raise rates at least once more before Philip Lowe is replaced by Bullock in September, whereas the RBNZ are firmly at the end of their tightening cycle. They are done and dusted, and it's now a question of when do they start to look at loosening policy, whereas the RBA haven't actually reached their terminal rate just yet. So I do wonder whether policy divergence is another theme that may come in to drive this in favour of the Aussie, in favour of further upside, at least over the medium term.
Yeah, and that's the sort of thing you can use to get a trade. If the RBA hike and the market's not really expecting it, you're probably going to see this rally up. If it gets up, as I say, up to that 111 level, maybe that's somewhere to look at for a short, because they go on pause again, and we get some reverting to the mean, as we like to say.
Yes, absolutely. We shall see what happens. Well, in that case, let's get on to our plays of the day. Right. Blimey, cable and euro dollar. The chart's moved on, so I best start talking. I think Kyriakos wants to go home or something. He's obviously clearly trying to hurry me up here. Right, cable. At long last, sterling's got a reality check. Yippee! Cable on track for 7 straight daily declines as we record this video. That would be the worst run for the pound since the early days of the pandemic, all the way back in March of 2020. We haven't actually spoken about it yet, but it was last week's inflation data that smacked sterling back down to earth. Cooler than expected headline and core CPI prints last week. So the market now expecting the terminal rate for the BOE to peak below 6%. It still sees about 5.8, which I think is a little bit high. But nevertheless, we have seen a dovish repricing there. We've seen a rally in gilts as well, both 2s and 10s down 20-ish basis points on the week. And cable has backed very quickly away from those cycle highs at 131.40. And we're now finding support at around 128.5. And I think this is kind of decision time for the pound. Do we see those losses extend back down towards the next support, which doesn't really come until kind of 126.60 to 126.80, where you've got that horizontal level. You've also got the 50 DMA and the bottom of this upward channel that's been in place since the beginning of March. It won't come as much surprise to most that I continue to favour downside here. I think there is still a significant degree of hawkishness in terms of rates pricing for the market to price out. I think OIS has room to reprice further in a dovish direction. But I do think this week we're largely going to see this driven by the dollar. I think the balance of risks tilts hawkish into the Fed. But I do think if we get a test and or a break north of 130, then I would certainly reassess that view. But something for the bears at last, and I think there might be more to come in terms of cable. What about euro dollar, Ryan?
Yeah, euro dollar. It was mentioned we're going to be in for a roller coaster of moves on this one, and as you rightly said, don't guess what's happening in these trading situations. And what I tend to do is I try and formulate a plan to try and take advantage of certain price reactions as they come along. One of those is euro dollar, and the trade-off between the Fed and the ECB. These types of trade ideas, they tend to need all the boxes ticked along the way. So I have a list of conditions that must be met. So if the first part doesn't comply, then I won't likely get in a trade. But I see the ECB being a touch more hawkish than the Fed. And as we're seeing the euro dollar weaken on the poor PMI data, we could get a bit of follow through on stronger US data like the PMI this afternoon and consumer confidence tomorrow or today as you'll be watching this show. That will put the dollar on a further front foot going into the Fed. So what I'm looking for is that to put pressure on euro dollar, looking for a long to get on a decent dip, to play a potentially pausing Fed or at least not as hawkish, to then run into a potentially more hawkish ECB. Now, as I said, it's difficult to put a price level on an entry because I'm going to have to do this on the fly, and it's more about timing than the price level. But I'll be eyeing the low 110s through to 109 potentially. But if we get what I feel is an excessive move, maybe down to the mid to low 108s, I may be tempted on a technical front to pick some up. So, yeah, I'm looking for a bit of a 1-2 punch between the Fed and the ECB to maybe get in some longs.
Good stuff. Well, that brings us to the end of another show as we've run through there. An absolutely incredibly busy week lies ahead. So good luck if you are out there trading it during the week. Hope you've enjoyed the show. As always, if you have, then drop a like on the video as well. Leave a comment. Let us know how you're trading the markets. Thank you as always to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, and to our producer Kyriakos as well, who's done this, brought this together brilliantly despite the sweltering heat that he's currently dealing with out in Cyprus. All three of us will be back again this time next week, and we'll be picking the bones out of what's gone on out of all these central bank decisions and data releases, and hope you can join us then. Thanks for watching, and goodbye for now.